Dean, you are the hedging vol guy, so you mentioned that you want to protect the gains that you may still have for the S&P up to the end of the year. What's the right strategy?
Right, so there's a couple of things you can do. The first, I would say, is when most people think about using options, a lot of times it goes towards puts, right, protecting. You can protect your portfolio using calls as well, which is noting that the last 2 months of the year are actually typically quite good for equity markets. There's almost a seasonality towards the November and December timeframe. That's not to say that this will happen this time, but one of the things you can do to be defensive is actually to take some of your long equity exposure and just swap it out for a call option. And what that does is it's going to give you continued upside in the market, but to the extent that, let's say, something very unforeseen or unwelcome for markets comes from this G20 meeting, you're going to lose, obviously, your option premium, your call option premium, but you're going to lose less because you're not just long the call option. So that's one defensive strategy. Another thing I would just want to add is that there has been an absolute surge in hedging in an instrument called the HYG. This is the high yield ETF. The option volumes are running at about 4 times their average, and the ratio of put options to call options, so the downside versus the upside trades, is about 6 to 1.
Wow.
So a tremendous amount of credit hedging. And you know what we'd seen earlier this year was equity volatility and an equity sell-off in February and March that really wasn't impacting other parts of the market like credit. It's actually definitely started to hit the credit markets as well. So there's a lot of nervousness in the credit side too.